So next we want to talk a little bit about the ratio analysis for Zynga. First we want to take a liquidity ratios, followed by activity ratios, leverage ratios, and then kind of interpret these to see what they really mean, because a ratio doesn't really mean a whole lot without any comparison. So first, starting with the liquidity ratio, we want to take a look at the current ratio, which measures the firm's current assets compared to its current liabilities. And for Zynga, it has a favorable 4.71 current ratio compared to some of its peers. So this can mean a couple of things, whether or not you have low liabilities, current liabilities, or you have current assets that are really outnumbering these current liabilities. I think in Zynga's case, if you look at their assets, and I think this will hold true to some of the competitors, is that the goodwill, which is an intangible asset, really looking at the premium paid on things in acquisitions such as patents and other intangible, really sometimes difficult to measure assets when you're looking to acquire a company. And we looked into their goodwill that they have listed on their balance sheet, and it looks as if though there hasn't really been any impairment of this goodwill, which would essentially be them looking back at the goodwill and saying, how much real value is in these premiums that we paid for the acquisition. So we haven't seen that since 2012 or 2013. The company did take on a series of acquisitions to try and grow and reach a new base. However, there wasn't really any impairment on that. So for that, it's a good sign. Looking at that current asset number in relation to current liabilities, it is a favorable number. It's better to have a higher number compared to its competitors to see how liquid kind of the company is, how easily they can turn their assets to cash. Next we looked at the quick ratio, which is looking at the current assets minus their inventory and dividing by your current liabilities. And this was the same, just due to the fact that they don't have any inventory listed on their balance sheet. However, they actually have said, the management, in their Form 10-Ks, that they have inventory in the sense of advertisement space that they're selling to other people. So there's no physical inventory, so that ratio stays the same, as they're not subtracting out any inventory. And this again was a favorable number compared to some of their competitors, I think, in sense in their current assets segment with the goodwill. Next, we want to look a little bit at the leverage ratios, and this essentially is looking at how much debt the company has and how they're performing in relation to how much debt they have. So first, we want to look at their debt to assets. Basically, so they have a debt to asset ratio of 0.16, which is showing that they don't have a lot of debt, and we also want to look at their high asset number as well. This was a lot lower than some of their competitors, and this was favorable in the sense that they're not funded by a lot of debt, and they're not under the burden of making interest payments. Next, we want to look at the debt to equity, and this is kind of a look at the capital structure of the company and see how it's really financed through debt or through equity. As I mentioned, there's not a whole lot of debt on this company's balance sheet, and that could be favorable in the sense that they don't have to meet the burden of these interest payments, and if they don't have the cash coming in, they might not be able to pay it. However, they don't have this liability of debt on their balance sheet, where some of their other companies might. On the other hand, debt, as said by Jim Mahar, makes good times great, bad times horrible. So, if you're really in a thriving industry, debt is relatively cheaper to the cost of equity. So having debt finance some of these projects could really help them in the long term. However, they don't have any of this debt. Next, we want to look at kind of their activity ratios. And first, we want to look at the total asset turnover. And this is kind of taking a look at the amount of sales they have in comparison to their total assets. Their asset turnover ratio is 0.36, where competitors are at 0.73 and 0.31. EA Sports is a little bit higher, as well as Activision is a little bit lower in this sense at 0.31. Next, we want to look over at inventory turnover, and because there's not really a whole lot of inventory in general for Zynga, this is a difficult ratio to really analyze a company with. When you have companies with EA and Activision with actual physical inventory, so we won't really use that ratio to compare these three companies. Um, Next, we want to look a little bit at their profitability and their gross profit margin in general first. So this is looking at the sales minus your cost of goods sold, and then divided by your sales to kind of look at how you're doing, how much profit you're making on your sales. And they have a gross profit margin of 0.69, where their competitors EA are at 0.68 and Activision is at 0.94. Um, Even though the company is not turning a profit, they are profitable on their revenue. However, there's other expenses that essentially will bring this net income number negative, even though they are profiting in a sense of the cost of their revenue is not exceeding the actual revenue numbers. Next, we want to look at net profit margin, which is looking at their net income compared to their sales. And this is where we look at and we see a negative ratio for Zynga at 0.16. EA is at 0.19 and Activision is also at 0.19. So this is showing that their competitors are actually profitable on their net income side compared to their sales, whereas Zynga, while they have sales, obviously, they're not actually turning a profit and have negative net income. And lastly, we kind of want to look at return on total assets and look at the net income in relation to total assets and see how they're leveraging their assets and whether or not they're able to be profitable on that bottom line. So with Zynga, we see a negative 0.06, EA Sports at 0.14, and Activision at 0.06. So we see that their competitors are doing a better job at leveraging their assets and turning a profit in this sense. So overall, I think it's difficult to look at some of these ratios and kind of analyze how they're doing, even though I think the major one that sticks out is definitely the profitability, where their competitors are actually turning a profit and Zynga is not. I think as we go forward, the fact that the company has no debt definitely reiterates the fact that the company has a strong balance sheet. So that could be something in the future that they could leverage up, take on some debt, and maybe invest in some projects that will help them turn profitable in the long term.